All right, let's just dive straight into this explainer and unpack a massive structural shift happening right now in the Australian resources sector. If you follow the share market at all, you know our national wealth basically rests on red dirt, right? We're talking trillions of dollars over the decades, dug straight out of the Pilbara and shipped overseas. But look, the global push toward net zero is actively rewriting the fundamental rules for our mining giants. And this isn't just some minor blip in the commodity cycle. It's a literal tectonic shift that directly impacts your superannuation and your personal portfolio. We really need to understand how this works because, honestly, the companies that got us here, they might not be the same ones that carry us forward. So, we've got to start by asking ourselves a pretty uncomfortable question. Are our investments actually positioned for the transition away from traditional mining dividends and toward critical minerals? I mean, for decades, the script was incredibly simple, wasn't it? You buy the big miners, collect those massive, reliable dividends, and watch the iron ore price like an absolute hawk. But things are changing fast. At its peak, China was swallowing well over 1 billion tons of iron ore a year to build out these explosive, unprecedented megacities. Now, though, that old-school reliability of iron ore is crashing headfirst into a maturing Chinese economy and the world-altering potential of the energy transition.
To make sense of this whole chaotic paradigm shift, here's our roadmap for today. First, we'll look at the red dirt legacy. Then we'll check out the copper pivot. After that, we'll compare the giants to the pure plays, dive into the green iron gamble, and finally wrap things up with what we're calling the new gold rush.
Okay, Section 1, the red dirt legacy, the true backbone of Aussie wealth.
Look, we absolutely have to respect the king here. Iron ore has essentially funded our schools, our hospitals, and, let's be real, a huge chunk of our retirement balances for decades, mainly through giants like BHP, Rio Tinto, and Fortescue. The old strategy was this brilliant set-and-forget dividend machine. But from an analytical standpoint, there's a major, undeniable shift happening on the demand side. China's property sector is cooling down. That insane building cities from scratch phase is basically maturing. Now, does that mean iron ore is dead? No way. Absolutely not. But the new reality of the energy transition means that if you're still relying on that passive, set-and-forget strategy from 20 years ago, you desperately need a strategic update to catch the next wave of growth. So, to figure out exactly where the strategic value actually is right now, we're going to use a really clear three-step framework pulled straight from recent market data. First up, the pivot, how companies are aggressively shifting their assets. Second, comparing pure plays against the giants to gauge risk. And third, calculating the massive impact of the new green premium. Let's test this out. Step 1, the copper pivot. The established giants are not just sitting on their hands while the market shifts around them. They are aggressively reweighting their portfolios to be more than just iron ore plays. They're making these massive, multi-billion-dollar strategic moves. Take BHP buying Aussie Minerals, for example. This was not some minor bolt-on purchase. BHP dropped nearly $10 billion to absorb them. Why? Because they wanted to lock up massive, long-life copper and nickel assets right in their own backyard in South Australia. It's an incredible defensive maneuver, but also a viciously aggressive offensive strike. As an investor, you have to watch acquisitions of this scale closely. They're practically shouting that the world's biggest miners are transitioning into transition material powerhouses. And there is a very specific reason they are hunting for these exact assets. You literally cannot build an electric vehicle, a wind turbine, or upgrade a modern power grid without massive amounts of copper. It is the absolute non-negotiable bedrock of the energy transition. Just to give you an idea of the staggering scale we're talking about, a single offshore wind turbine can require up to 8 tons of copper per megawatt of capacity. In an EV, it uses roughly 4 times the copper of a standard gas-powered car. It's totally mind-blowing when you run the numbers. That is exactly why copper is being called the new oil. The physical demand is structurally hardwired into the global push toward net zero.
Moving right along to Step 2, giants versus pure plays.
Now we really need to compare these slow-turning, diversified ships with the volatile, fast-moving upstarts. Think about the legacy giants like BHP and Rio Tinto as massive supertankers. They are heavily protected by existing cash flows, sure, but it takes them miles and miles to turn the ship and pivot their operations. On the flip side, you've got the pure plays, companies like Pilbara Minerals and IGO. Think of these guys as speedboats. They are right in the explosive thick of the lithium and nickel action, offering pure, unadulterated exposure to the energy transition. Naturally, this is where the heart-pounding volatility lives, absolutely, but it's also where having incredibly deep strategic insights can unlock sudden, massive upside. But look, keeping your sanity when investing in those pure plays requires a profound understanding of time frames. If you spend your days frantically refreshing daily lithium spot prices to track the one-month roller coaster, you are going to drive yourself completely crazy and probably make some highly emotional, terrible trades. But if you zoom out to a 10-year horizon, an undeniable structural supply-demand gap for battery metals becomes glaringly obvious. There simply aren't enough operational mines on the planet to meet the battery demand projected for the next decade. When you anchor yourself to that 10-year physical reality, you realize those sudden, violent one-year market dips, yeah, they're often just noise.
All right, step 3, the green iron gamble.
You see, the energy transition isn't just about mining new metals. It's also about completely changing how we mine the old ones. And this concept of the green premium is going to heavily dictate the next decade of mining revenues. In the very near future, especially with European regulators bringing in carbon border taxes, the world won't just want any iron ore. They're going to specifically demand green, decarbonized iron ore. More importantly, global steelmakers will be forced to pay a premium for it or else face severe financial penalties for using dirty materials. It is a massive existential shift in how raw materials are globally valued.
And that context perfectly sets up Fortescue's massive, highly scrutinized strategic gamble. Under Andrew Twiggy Forrest, they aren't just tweaking things at the edges. Oh no, they are betting the house. They've committed billions in initial capital to become a green hydrogen pioneer, with the goal of entirely decarbonizing their operations by 2030 just to lock in that lucrative green premium. It is a wildly bold, almost unprecedented move to rewrite the core DNA of a top-tier miner. They're trying to pivot from just digging up dirt to being a global green energy titan. The sheer scale of the ambition, and honestly, the capital risk, is genuinely amazing to watch.
So, as an investor trying to navigate this, you have a critical decision to make about the very identity of the stocks in your portfolio. When you evaluate a company making these kinds of colossal moves, what exactly are you valuing? Are you buying into a traditional cash cow mining company, or are you effectively funding a highly speculative green tech pioneer? Can Fortescue actually pull off this massive engineering feat and secure that global green premium? Or is this just a massive, risky capital sinkhole built on a giant what-if? That comfortable line between a traditional miner and a tech company, yeah, it's blurring incredibly fast. Which brings us to our ultimate takeaway: the new gold rush. The energy transition is not a threat to the old iron ore guard. It's honestly the biggest opportunity for the Australian market since the original gold rush. But you can't just throw darts at a board and hope to strike it rich. You need a rigorous approach. Here's a quick checklist for you. First, analyze the cost curves. When commodity prices crash, and trust me, they will, being in the lowest quartile of production costs is the only thing that saves a company from bleeding out. Second, evaluate the raw quality of the resource in the ground. Grade is king. A poor quality resource will never be profitable, no matter how high demand gets. And finally, check that future-facing metal mix. Ask yourself, how much of their revenue is actually tied to the transition materials of tomorrow versus the legacy materials of yesterday?
I want to leave you with this final, really profound thought to chew on as we wrap up this explainer. The global economy is physically rebuilding itself from the ground up, and that requires a ton of raw materials. But the fundamental nature of those materials has changed forever. So, what's your play? Are you sticking with the historical comfort and safety of traditional iron ore dividends, trusting the old giants to navigate the storm? Or are you willing to stomach the volatility and bet big on the high-growth transition metals that will literally power the next 50 years? The paradigm has entirely shifted, and the choice for your portfolio is completely up to you. Just keep this framework in mind the next time you log into your brokerage account.